In 2026, you can earn $24,480 and still collect your full Social Security benefit. Most people collecting Social Security have never heard that number, and not knowing it costs them in one of two ways. Either one, they're leaving thousands of dollars in benefits uncollected, or they're avoiding work that they legally could do without any penalty. Today, I'm going to show you exactly how Social Security, the earnings limit, works, what happens if you go over that limit, and why the rules are far more favorable than most people assume. Look, stay with me through the middle section, because the piece about what actually happens to the benefits that do get withheld is the part most people have never heard. And it changes the calculation completely. Most people approaching this decision, they fall into one of three groups. Each one is making an expensive mistake, but for a very different reason. Group one, people who are at or near claiming age, but they could be avoiding all work because they believe any earned income will eliminate their Social Security benefit. They're leaving their full benefit on the table and earning nothing when they could legally be doing both within the limit. Group two, people already collecting Social Security who believe they cannot earn a single dollar without triggering some kind of penalty. They've turned down consulting work, part-time opportunities, and flexible income because nobody showed them the actual threshold. Group three, people who claim Social Security at 62 based on their financial advisor's recommendation. The advice sounds reasonable and, quite frankly, exciting about retiring early. It sounds that way on the surface. Get the money working for you sooner, invest it, and let it compound. What most advisors fail to explain is what happens if you're still earning income while collecting early. Here's the scenario I want you to think carefully about. You claim Social Security at 62 based on your advisor's recommendation. You're not fully retired yet. You're still working, consulting, doing something that generates income. If that income exceeds $24,480 in 2026, your Social Security benefits start getting withheld. Earn enough above that limit, and you're going to wipe out your entire benefit for the year. You claimed early, you took the permanent reduction that comes with claiming at 62, and you received nothing. The first question anyone should answer before claiming Social Security at 62 is not, hey, should I invest it early? It's this, do you need the money to live right now? And if the answer is no, and you're still earning income, claiming at 62 is a very expensive financial mistake that you're going to make in retirement. And yet, it's one of the most common recommendations I see on YouTube all the time. Let me show you exactly how the rules work so you can make the decision with the full picture right in front of you. Rule set one. If you're below your full retirement age for all of 2026, all right, the earnings limit is $24,480 this year. That's exactly $2,040 per month. Below that threshold, you keep every dollar of your Social Security benefit and every dollar of earned income. No reduction, no withholding. You get both in full. Above that threshold, for every $2 you earn over that limit, $1 of benefits is withheld. Now, here's what that looks like in practice. If you earn $30,000 in 2026, while below your full retirement age, okay, you exceed that limit by $5,520. Social Security is now going to withhold $1 for every $2 over. So in this case, about $2,760. In practice, that usually means a few full monthly checks are going to be held back entirely, not a small reduction from each payment going forward. So if you're expecting a check and it doesn't arrive, that's likely why. And importantly, the money is not lost though. Your benefit is adjusted upward at your full retirement age to account for those withheld months. The government held it, but it does return it in the form of a higher monthly check for the rest of your life. We're going to come back to that and get a better explanation in a moment. Rule set number 2. If you reach your full retirement age in 2026, the rules change significantly and favorably for the months before your birthday. The limit jumps to $65,160 for those months. And above that threshold, $1 is withheld for every $3 earned over the limit, a significantly better ratio. Once you reach your full retirement age, that earnings limit disappears entirely. You can earn any amount at all, and collect your full Social Security benefit simultaneously, no reduction. Now that age cliff, the moment the limit disappears, is one of the most important dates in your retirement timeline. And most people have no clue that it even exists. Look, I want to go back to a word we talked about before, temporarily, because this is the piece that changes everything, and it's the piece that almost nobody really explains clearly. When you reach your full retirement age, Social Security recalculates your benefit upward to account for every month your benefit was withheld because you made too much money, right? Excess earnings. The withheld months are credited back as if you had claimed later. That means a higher benefit for the rest of your life. Let's give you a concrete example. If 12 months of benefits were withheld between 62 and your full retirement age, Social Security adds those 12 months back at your full retirement age, your FRA. Your benefit is now permanently increased to account for those 12 months. The government didn't take the money, it was holding it, and it will pay it back in the form of a higher monthly check going forward for as long as you live. Now, let's be really clear about a little nuance there. The recalculation is not an instant dollar for dollar return. It takes time to break even on the withheld months. So for some with a longer life expectancy, that recalculation, it works in their favor. For some with a shorter life expectancy, the math will likely be different. The point is not that going over the limit is always fine. The point is that the consequence is far less severe than most people assume. And in many cases, it's not a permanent loss at all. That's a very different story than most people have been told. So here's something that surprises almost everyone. Not all income counts toward the earnings limit. Only earned income, W-2 income, or money from a business count. The distinction between what counts and what does not is one of the most practically useful things that I'm going to show you today. So what counts? Earned income, wages from a job, net self-employment income. So consulting fees paid as compensation for services counts. Bonuses and commissions count. What doesn't count? Investment income, dividends, interest, capital gains, pension payments, IRA and 401k withdrawals, annuity payments, your Social Security benefits themselves, and rental income, if it's truly passive. Let's put that in practical terms. If you have a rental property generating, let's call it $800 a month in passive income, that money does not count towards your earnings limit. If you're drawing from your IRA, does not count. If you receive investment dividends, those do not count. The limit applies specifically to income you earn by working, not to income for money that's making money for you. One thing worth knowing, especially if you're self-employed or consulting, the earnings limit applies to net self-employment income, not gross. That means legitimate business expenses reduce the number Social Security is looking at. So someone consulting for, say, $2,000 a month who has legitimate business expenses of, call it $500, has a net earned income of $1,500 a month. That's under that monthly threshold. Understanding this distinction can bring someone under the limit who assumed that they were over it, right? It's something to talk to with your tax advisor about. Now, here's the practical question that most people in this audience are really asking. Can I retire from my primary career, do some work that I actually enjoy, and still collect Social Security at the same time? For many people, the answer is yes. Here's how. Strategy one, the income sweet spot. If you're below your full retirement age and you want to work part-time, the $24,480 limit is not a ceiling to be afraid of or to avoid. It's a target to aim for. Earning up to $2,040 a month in flexible income while collecting Social Security provides a combined monthly income that will close most retirement gaps, and it doesn't trigger any withholding. You don't lose any benefit. Like if you watched our earlier video on building a $3,500 retirement, this is layer one of that income stack. I'll put a link to it right here. Social Security plus earned income within the limit gets most people to or even past their retirement number before they touch a single dollar of savings. Strategy two, the full retirement age timing consideration. If you're within 1 to 2 years of your full retirement age, it may make sense to delay claiming entirely, continue working at full income, and then claim at your FRA when the earnings limit disappears. For someone close to that birthday, waiting a few months for the rules to change entirely can be more valuable than claiming early and managing around the limit. Number three, the self-employment bridge. If you've left a primary career, but you still have marketable skills, structure self-employment with legitimate business expenses can generate meaningful income that stays under or near the limit, while providing the purposeful, flexible work that makes retirement sustainable financially and emotionally. Most people in this audience are closer to a working retirement than they realize. Not a retirement where you work because you have to, a retirement where you choose to do something valuable on your own terms. And the income from that choice, combined with your Social Security benefit, creates a foundation that is more stable than either one alone. The earnings limit is not a barrier. It is a planning tool. And now you know how to use it. Two things before you go. First, if you've not yet found your real Social Security benefit estimate, watch the video. It'll be in the link below. It'll walk you through SSA.gov step by step. It'll give you the three numbers that we talked about today. Those numbers are the foundation of everything we talked about. Second, if someone you know was told, hey, just claim it at 62 while you're still working, and nobody mentioned the earnings limit, send them this video. That conversation could save them thousands. Next week, we're going to look at what your Social Security statement is actually telling you, and the one number that most people never noticed. Subscribe, and you won't miss it. I'll see you then.